Welcome to the Topic 6 workshop, and today we'll be calculating the cost of capital for H&M. Now in front of you, you see the spreadsheet for this week, and you can see an overview of what we're going to be doing. So today we're going to be needing to do is calculate the cost of capital, and specifically we'll be using the weighted average cost of capital, which you probably would have heard about in a few other classes. So in front of you, you can see the setup. We'll need to figure out what the capital structure of the company is, what the cost of debt is, and then what the cost of equity is, and together all of those will give us the weighted average cost of capital. Now, today we're going to be focusing on is really figuring out all the individual assumptions, specifically within the cost of debt and within the cost of equity. So we're going to be looking at how do we figure out the cost of debt, how do we figure out the beta, the risk-free rate, the market premium, and so on. Probably the most important part for this week is really the beta. And again, beta is something you would have covered in maybe your fundamentals of finance class or even some other classes as well. Now, beta, as it's taught in introductory classes, is really something that we usually estimate by running a regression where we compare the returns of the stock to that of the market to figure out what the relative risk is. Now in Bloomberg, there's a function called beta that allows you to more or less do this for you. So if you go into beta on Bloomberg, and again, you don't have to do this right now, you're just looking at me doing it so you can figure out how to do it in class yourselves. In front of me, I can see the beta section on Bloomberg, and how it works is that you enter in a company name. So in this case, I'm going to be using H&M as my security of choice as my example, and I can also see basically a graphical overview of the returns of H&M versus that of the returns of the market. And for this section, what you can see, it's using H&M stock, and the relative index is the OMX index, which is the Swedish stock index. And it's currently using weekly prices. You can set this to daily, monthly, and so on. And it currently has a 2-year time period. So it basically goes back 2 years in time to look at the relationship between the stock and the market. Now, again, this is kind of how you would do it in practice. And for example, a weekly 2-year beta is nothing wrong with doing it exactly the way it's currently structured, in which case you might use a 0.749 beta for H&M. Now, what's important to remember, and I'll cover this in the lecture, is that the Bro beta is a point estimate. So basically that's your best guess. But that best guess always needs to be considered in relation to the standard error, and the standard error is 0.172. So if you go back to your statistics class, you might have been exposed to the concept of confidence intervals. So even though 0.749 or about 0.75 is your best guess, if you want to estimate a 95% confidence interval, so if I kind of simplified it, that you're 95% sure it kind of is between this range, then what you would need to take is 0.749 plus the standard error multiplied by 2, that gives you your upper range, and 749 plus the standard error multiplied by 2, minus the standard error multiplied by 2 gives you your lower range. So if you multiply that standard error by 2, that's about, let's say about 0.3-ish, which means that 0.749, even though that's your best guess, the actual 95% confidence interval is that number minus about 0.3 and then plus 0.3. So it's actually a huge range. So it's about 0.45 to about 1.05. So it's a huge range, and it's not necessarily that precise once you start thinking about the confidence intervals. Not only that, there's so many various choices you can make. For example, the default is that you use the Swedish stock index. So basically, they tend to use the index where the company is listed, which historically was nothing wrong with that when investors tended to mainly invest within their own countries. But in H&M's case, most of their current investors tend to be international investors. So for them, it would be much more useful to know what is the relative risk of H&M to that of a global index. So one of the global indexes that you might use is the MSCI World Index. So I'm just going to type in MSCI World Index, select it. I need to press enter and see what happened. Well, you can see that the raw beta dropped from about 0.75 to about 0.56. So it's about a 0.2 of a drop. Not only that, the standard error is now quite huge. So it's about 0.25. So you can see even just a simple change of an index dramatically changes the raw beta estimation. Similarly, you can choose weekly, daily, or monthly prices. The main thing is that when you have a 2-year period, you can only use a daily or a weekly price. And that is the reason is because for the, observations, we do tend to say that we need at least 60-ish observations. So down here on the right-hand side, you can see number of points. So that's basically how many days of observations we have in our sample. We need to have 60. So for a weekly, in order to have 60, you need to take a 2-year period. So I could switch to daily, and I can see what that does. So it jumped from 0.5 something to about 0.88. So again, you can see quite a dramatic change. I can change daily to a, let's say I currently have a 2-year period. Maybe I can change to a 5-year period to weekly, and it drops to 0.73. For a 5-year period, I can also say monthly, perhaps 0.695. So basically, no matter what change you make, it's going to be impacting the beta, which is also why it's a bit imprecise and highly controversial, because there's so many different choices you can make to more or less determine whichever beta you want. Now, in industry, probably the most commonly used betas are either a 5-year monthly beta or a 2-year weekly beta. So generally speaking, I would tend to use a 2-year beta for a weekly as kind of my benchmark. Again, this is not a great one because, again, 0.564 plus 0.244 multiplied by 2. So effectively, my lower range is going to be almost 0, and my upper range is going to be around 1. So it's not really a very precise estimate once you start to think about it from a confidence interval point of view. So an alternative way you could estimate beta is by looking at comparable firms. So this is how you would usually do this when you want to estimate beta for a private firm, but you can also technically use it to estimate beta for a public firm as well. So you essentially find comparable firms, figure out what their betas are. So here on the homework sheet, you can see here on the right-hand side, I have 4 companies here. I have Zara, Uniqlo, Gap, and Esprit that I've chosen to use as comparable firms. I've already found information for 3 of them, and I'm going to demonstrate how to find information for Zara. So what you can see is essentially I'm finding the beta estimate for each of these companies, and I'm then adjusting for their capital structure and their tax rate to get the unlevered beta. So the unlevered beta would effectively be their beta that is not dependent on their capital structure, because some firms choose to use more debt, others use a whole lot more equity. And the more debt you choose, the higher your raw beta will be. So for example, with Gap, which has a raw beta of 1.07, that 1.07 is biased upwards because it has debt. The true beta, or the unlevered beta that is associated with being within this particular business segment, is 1.01 for them. Okay, so what I'm going to be doing here is I'm going to be looking at trying to get this information for Zara. So what I'll be going to be doing is going to Bloomberg and figuring out what is the raw beta for Zara. So Zara is technically called ITX SM Equity on Bloomberg because that's their formal name. Press enter. I also want to switch this to the MSCI World Index. Usually I do this for basically every large firm out there, because for most large firms, their kind of relative benchmark index is more of a world index rather than their local index. Press enter. And you get a raw beta of about 0.907. So 0.907 is what I'm going to be entering into the beta field. The debt and equity of Zara, that I can grab from the FA function. So if I go in Bloomberg again, type in FA, press enter, I can see that the current market capitalization is about 84 billion. I'm going to copy that and I'm going to paste it into equity. So it's 84,243. For the debt figure, I'm going to get the total debt line item. So essentially Zara has almost 0 debt, so about 111 million, which is almost nothing. I'm going to copy that, paste into the debt section. Now what I'm going to be doing next is figuring out their capital structure. So I'm going to take their debt divided by their equity. So essentially they're almost entirely funded by equity. And to get the tax rate, we're going to be doing exactly the same exercise as for forecasting. So for example, here under the marginal tax rate, I actually have the link there in the comment section. So again, we're going to be using the KPMG website to figure out what is the tax rate in the country where Zara is headquartered. Now, Zara is headquartered in Spain. So if you go to Spain, you can see that the current tax rate in Spain in 2018 or 17 is about 25%. So I'm just going to be entering 25%. So what this section does is that it effectively provides you with a view of what the average beta is that is associated with this industry, assuming that the companies would have zero debt. So it kind of gives you an idea of what a comparable firm beta would be. So again, it's basically up to you for your project whether you want to use your own company's raw beta or this beta, but you always need to consider kind of what is the potential range that might be, and you always need to consider it from a sensitivity analysis point of view, which I'll later show. So in order to figure out the next steps, because what you see down here is, for example, the relevered beta. The relevered beta basically takes the averaged unlevered beta and then relevers it according to the H&M's capital structure. So if they had a huge amount of debt, this 1.11 would actually be much, much higher. If they had zero debt, this would still remain at 1.11 because again, they would be having entirely equity funding, which means that their relevered beta and their unlevered beta would be exactly the same. So what I'm going to be doing next is to figure out what is the capital structure of H&M. So for H&M, I'm just going to go into Bloomberg, switch the FA function to H&M, press enter, and I can see that their market cap currently is about 234 billion. Going to copy that, go back to Excel, paste it into the market value of equity, go back to Bloomberg. I can look at the total debt, which is about 10 billion and some change, copy that, go back to my Excel spreadsheet and paste that into the cell. So my next part is to figure out what is the relative proportion of each one in relation to the total capital structure. So to get the total capital structure, all I do is I add these two up. And then I take the total debt in C3 and divide it by C5 to figure out what is the proportion of debt. And then I take my market value of equity divided by C5 to figure out what is the proportion of equity. And that gives me my capital structure. So what you can see here, for example, now the relevered beta has the H&M capital structure, which is about 4%. And what you can see is that although the average unlevered beta is 1.11, because H&M introduces additional risk by holding debt, the relevered beta is a bit higher, so 1.16. And that is essentially the first part. We then need to figure out what is the cost of debt and also what is the cost of equity. Now, the cost of debt for some firms is easily observable. So if you were dealing with a US company, you could look at their corporate bonds. And again, I'll go through in the lecture how you would do that. For a Swedish company, because they don't issue corporate bonds, you can either go through the footnotes and figure out what are they actually paying as an effective kind of interest rate to all the banks that they've borrowed money from. Or what you can do is you can actually estimate a synthetic cost of debt by looking at the current risk-free rate and then adding a credit spread. And these credit spreads are to some extent based on the credit ratings from S&P and Moody's. But what we're doing here is really creating a synthetic rating because H&M in this case does not have a rating because they're not issuing corporate bonds. And this synthetic rating is completely based on the interest coverage ratio, which we can see down here. And if you go into the comment section, it says EBIT divided by interest expense. So for example, for H&M, in order to figure out what the synthetic rating should be, I might go into the interest coverage ratio and calculate it by taking the EBIT from the data sheet. So I'm going to go down to EBIT in cell H67, and I'm going to divide it by the interest expense. Now in H&M's case, it's actually a bit tricky because H&M actually has interest income. So you're essentially dividing it by a negative, so you're going to get a negative number, which looks like it's really bad if you compare it to the, I guess, the table itself, because it looks like the interest coverage ratio is about in the worst possible cell, but technically it's the reverse. So this cell is technically for the companies that have a negative EBIT, so negative profits, but a huge interest expense. In H&M's case, it's the exact opposite, so we essentially consider it to be a AAA rated company, which means that we're going to be looking at the risk-free rate plus a spread of about 0.6. Now, to figure out the risk-free rate, there's a few different ways. In Bloomberg, there is a function called WACC, which is basically doing what we're doing, but in a much more simple way, and it's not necessarily used that much in practice. But it's good to figure out what is the, I guess, the appropriate risk-free rate for H&M. So for H&M, if I see the risk-free rate here, and if I hover over at 0.88, I can actually see that it's based on a security called the GSGB 10-year index, and that's a Swedish 10-year government bond index. So in this case, I might say I'm going to use 0.88% as my risk-free rate. But again, technically speaking, this is not necessarily a good risk-free rate to use because historically it's super low. And if we're valuing a firm for an eternity, essentially, we want to use a normalized risk-free rate in most instances. And most people would probably say a normalized risk-free rate right now in Europe is about 3 to 4%. And again, I'll show you later on how the WACC will be sensitive to this assumption. So now that we have the risk-free rate, we're going to take and calculate the cost of debt, which is going to be our risk-free rate plus the credit spread of 0.6. So our cost of debt is about 1.48%. And to be fair, H&M could borrow at this rate currently. It's questionable whether they can borrow at this rate for a longer time period. Now, the marginal tax rate for H&M is again something we can grab from the KPMG tax table. For Sweden, I can see that the tax rate is 22%. So the marginal tax rate is 22%, which means that the after-tax cost of debt is my cost of debt multiplied, open up a bracket, 1 minus the marginal tax rate because interest expenses are tax deductible. So it's about 1.15%. Now, the next section in the cost of equity is the beta itself, and we can just technically right now just link it to the re-levered beta. Again, you could use your own regression beta here, but you basically need to justify why you're choosing one or the other. And again, what I would always do is to figure out what is the sensitivity of choosing this versus the other and so on. Now, the market risk premium is the premium equity investors get for investing in equity. So it's basically the additional premium they get in investing in an average, I guess, risky stock. In Europe right now, most people would use about 6%. In the US, it might be about 5%. In Australia, about 5.5%. But again, I'll go through how you might find that. The other premium is something that we sometimes add to companies that are based in a developing nation. So they might have country risk, or if they're small, in which case we might actually have them some form of a size premium here as well. For H&M, it's a large company in a developed country, so the other premium is 0. And then the cost of equity itself is going to be equal to the CAPM formula, which is the risk-free rate plus the beta multiplied by the market risk premium, so about 7.77. And then finally, the weighted average cost of capital is going to be equal to your total debt, so essentially D3. So basically the proportion of debt you hold multiplied by the after-tax cost of debt plus the proportion of equity multiplied by the cost of equity. So you get about 7.5% here. So I'm just going to remove some of the decimals here to clean it up. And again, so we get about 7.5% here. And that's kind of what you could use as the weighted average cost of capital. But again, remember, this is extremely sensitive to the assumption of the risk-free rate and also the assumption of the beta. Because again, when we look through the regression betas, they're about 0.5 to 0.9, just the point estimates. The re-levered beta, according to comparable firms, is at 1.15. So you could actually say it's anywhere in that range. You really have no idea. So what I would suggest to do is to use a sensitivity table. So down here, we're going to be using a sensitivity table to figure out a what-if analysis, in the sense that what if beta was, I guess, 1, and what if the risk-free rate was 3%? What would the WACC be in that case, and so on. In order to do this, we're going to be using the data tables function in Excel. And to use the data tables function in Excel, basically what you do is you basically allow Excel to automatically calculate the sensitivity for you. To do this, you need to structure it in a particular way. So you need to have a numbers for the beta here, so potential values for the beta. So right now we have 1.15. So we might say 1.15 is our top end, and then we're going to take the beta minus 0.1 to the left of it, so it's 1.05. So about 0.75 to 1.15 could be our range. Again, it could be a much larger based on the fact that our regression betas did actually go down to about 0.5 and so on. Now for the risk-free rate, the current risk-free rate is 0.88%. We could say our range should be based on that plus 1%. So essentially, we're going to look at the ranges of beta from 0.88% to almost 5%. And again, if you go back 20, 30 years, a risk-free rate about this is not actually too abnormal. Even in Australia, we have quite high risk-free rates right now. So 0.88 is historically extremely low. So technically, this range is pretty realistic. So what we need to do now is we need to tell the sensitivity table what is it that we want to test for sensitivity, and we need to put it between these two items here. So we need to put it in cell G20. And what we're going to do in cell G20 is just referencing the weighted average cost of capital. So we're going to reference it to D19, and that creates the structure. Now, the next step is to highlight the entire area, go to the Data tab, and then under What If Analysis, click Data Table. Under row input, I'm just going to put the beta, and under the column input, I'm going to put the risk-free rate. Click OK, and you get Excel to basically do all the work for you. So I know right now, for example, that my risk-free rate is 0.88 and my re-levered beta is 1.15. If I find this in a table, I see it's 7.5, and that actually corresponds to with the weighted average cost of capital. Again, there's some decimals, which is why it's not 7.49 exactly. Now, if beta instead was 0.75, which if you were to use a regression beta is quite realistic, well, the WACC would be 5.2%. If, on the other hand, we still assume 1.15 beta, but the risk-free rate should be a normalized of about 3.8, well, then the weighted average cost of capital goes up to 10.48%. So again, these percentages might not seem great to you, but once we start to discount future earnings and cash flows using these discount rates, you'll see that a discount rate change of about 1 or 2% makes a massive difference. So what this essentially shows you is that cost of capital is extremely sensitive to all your assumptions. So from a valuation point of view, this is probably the most important week in terms of actually getting right. Now, again, once you've finished this, remember to answer all the questions at the bottom. And once you've done that, just upload it to iLearn.